Let's get more from Brent Joyce, Chief Investment Strategist at BMO, a private investment counsel, and BMO Private Wealth. It's great to see you.
Good afternoon, Andy. Good to be back.
We're pretty well halfway through the year. And is there anything that surprised you so far in 2025? Anything that you... I know it's hard to know where to begin, but what has jumped out for you as a thing you thought, wow, I never saw that coming?
Yeah, let me see if I can think of one. Especially on a day like today where a very much unchanged day and not a lot of surprises, no fireworks. But we think back at the beginning of the year, a lot of talk about the U.S. dollar. And we've been talking a lot about important feedback loops to the U.S. administration. And that eventually we're going to have action in terms of big, beautiful bill and tariffs, a reaction in the courts and the public opinion, but most importantly in the capital markets, and then a recalibration. And we're going to go through this cycle until we get somewhere that the capital markets can live with and tolerate in terms of those two policy changes. What we saw with the U.S. dollar in April was that it didn't show its traditional safe haven status briefly. And there was a lot of questioning around people exiting the U.S. market and foreigners walking away from U.S. assets and the like. I think there's a bit of that happening. But really, it was a surprise, but it hasn't changed my view that the U.S. dollar is still a safe haven. And the tragic events over the past couple of days with geopolitics in the Middle East, we've seen the U.S. dollar strengthen. And so even though some of the concerns around the uncertainty stem from inside the U.S. economy, the U.S. dollar is still performing that role more broadly for us, which is an important thing that we rely on as diversified investors.
What about the second half of 2025? What are the big themes you're looking out for, Brent?
Yeah, so we're trying to make sure that we're very disciplined around the data that we analyze. We haven't abandoned, our training and our fundamentals are the things we want to look at, right? Inflation, monetary policy, earnings growth, credit spreads, all these inputs that we have to our process. But we have to recognize that the shock that we've had this year, which has largely just been rhetoric to this point, not a lot of concrete action, and we're going to, we'll see that over the next few weeks, has already jumbled up the data. Whether it's on supply chains, certainly on some of what we call the softer data, right? The survey data. These are very emotionally charged. It's an emotional environment with what's been going on. And so we have to ask ourselves, is this really the story that we would expect it to be if we think about a reading that might have been outside of this emotionally charged environment? So what do we do with that? We want to look for corroborating evidence in other areas that would support a conclusion on what maybe the U.S. consumer is healthy, or the U.S. housing market, or the Canadian inflation story, things of that nature.
What about bonds? Let's put up a 5-year chart, a 1-year chart for the old U.S. 10-year yield. Sure. And we did see a few weeks ago, apparently the bond market flashing a red warning signal. People were worried about U.S. debt.
Yeah, and so this is one of the most important feedback loops. We saw it in the U.S. 10-year, more importantly in the U.S. 30-year that moved 60, 70 basis points. That's a pretty big move for the 30-year. Yeah. And who's in the 30-year bond market? It's largely the government. So that was a signal sent very directly to U.S. policymakers. Good to see that signal sent, good to see that signal received, and bond yields have retreated from those levels as we've seen a pause and some rethink on some of these more aggressive policies. We see bond yields today reasonably well priced. One of the things I think investors need to remind themselves, we're in the weeds here, in the minutia. Are we going to see a quarter-point cut, a half-a-point cut? It wasn't that long ago we were talking about hundreds of basis of points increases, right? And so let's be careful what we wish for. Fed Chair Powell had a question today, what would it take to make good on the president's 200 basis points of cuts that he was musing about? I'm not sure we want to think about that environment. That would be a pretty ugly economic environment where the Fed feels it has to cut rates by 2 full percentage points. So bond yields in the 4.5 range in the U.S. for 10 years, in the 3.30 range for 10-year Canada's, I think are priced pretty well to have this kind of binary outcome that's not massive, 20, 30 basis points in either direction, given what might happen with tariffs or policy and the economy as we move forward.
And you think there is a reasonable way for Trump eventually to stitch together a tariff policy that works for his economy and others?
I think we think about it in terms of, again, the emotions, right? And the numbers that have been swirling around in the first 6 months of the year. 145% tariffs, 50% tariffs, 20% tariffs. We're now in an environment where in Canada, we're sub 10% on an average tariff rate with the Americans. We can certainly do better than that, let's hope. On a global basis, if tariff policy lands in the 10 to 15% range, and you have different pieces of the puzzle that are going to mop up parts of that, profit margins for some, the currency for some, and price increases for others, that could look a lot like, again, we're just talking about the goods piece, we're just talking about imports, something that's maybe a 3 to 5% federal sales tax equivalent in the U.S. That's very digestible. It's Americans that are going to pay it. It would help on the fiscal side of things. We are seeing certainly the tariff revenue showing up in the Treasury, so it is real. Someone's paying it. That's a scenario where everybody can kind of walk out unscathed.